Kia ora and welcome to Shared Lunch, brought to you by Sharesies. I'm Helen Mattison. Today we take a pulse check on the economy. I'll be speaking with Infometrics principal economist Brad Olsen.
The worry now a little bit more is that households, businesses and professional forecasters are all now thinking that there is a bit more inflation to come.
So what does this mean for investors?
It's only a temporary pause that we're seeing with these tariffs, and that some of the results could still be pretty damaging.
What should you be looking out for?
Everyone's trying to figure out what the sweet spot is and sort of how to balance what is a lot of uncertainty.
And what should you ignore?
There's been this sort of recognition from a lot of people that, hey, sometimes the markets have been overcorrecting or a bit overly worried about things and then seem to come back the other way.
Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Brad. Great to see you again. It's been a while.
It has been a while, and goodness, what a lot has happened in the economy in that intervening period. Seems like we've gone from the brink of World War III to ceasefires to tariffs to everything else. I mean, it's been a pretty wild ride.
It has. Let's start here at home and think about our economy and growth. It appears that we are sort of stepping up a little bit after all the kind of recession talk, etc., etc. However, it appears to me that the only real growth we're seeing is in the rural sector, with milk prices, with beef for burgers to the US, which is good for exports, and then that yellow gold butter.
You're definitely right. I mean, the rural sector is definitely powering the early stages of the economic recovery. You look at the likes of the trade numbers we've got coming through, commodity prices all in a better place. I think it's true as well when you look across the world, that's also partly a supply story from other providers. So you look at the likes of butter, milk, other dairy products. New Zealand production's actually up, which is unusual when prices are sort of at the levels that they are. But it's production out of the likes of Europe and the Americas that haven't been doing quite as well. New Zealand's able to provide, everyone else wants to pay for it. We've been doing not too bad. You look at also the numbers though. So the milk payout that's come through has generated over 19 billion of money that'll be going back into the primary sector. What's interesting is in the season just finished, you're talking something like $4.6 billion more than the season before. That's more money coming through than the entirety of the lower interest rates that households will be paying this year. So the primary sector is definitely a very critical part at the start. The question is, does it continue? Because you do start to see a few of those numbers, the likes of the latest couple of global dairy trade auctions, they've fallen back a touch.
Yeah.
And I think that does just suggest, again, things are all right for the minute, but a bit of a question going forward in terms of how strong it will be. Fonterra's also made it quite clear that they think there's effectively a bit of a downside risk. They've come out, they've said, milk prices at $10 for the season ahead, but it could range anywhere between 11 and 8. That's a $3 range, the biggest they've ever provided, and more on the downside than there is the upside. I guess that's almost the tone for the second half of this year is, yep, there's a recovery coming through, but it's a very cautious and slow one.
Is it only the rural sector that are actually going leaps and bounds, or are there do you see other sort of green shoots, which is a bit of a hackneyed phrase at the moment, but I'll use it anyway.
First 3 months of this year looked all right. You saw economic activity that expanded actually quite a bit, 0.8%. Some of the biggest increase in quarterly growth that we've seen amongst a lot of our international partners. I think the challenge is after that, once you start to get into April, you have the likes of the tariff slowdown and everything else that's come through. You've seen some of those indicators that have fallen back. At the start of this year, there were a few parts, the likes of, there was some better manufacturing numbers that were coming forward. You also saw better professional services activity, so you're getting business services going a bit more. Again, both of those look like they've fallen back a touch as we've moved sort of through into the mid-year period. Manufacturing and services indices are falling back into sort of contractionary territory. So just that feeling of, yes, there's a recovery, but it's a bit more stop-start, it's a bit more slow to get going than we might have first expected. And I feel like a lot of people ask me these days, economists said survive till 25, and I sort of have to respond and say, look, we've got until the 31st of December for that to come true, but it is going to be a slow slog, I think, for this year.
Yeah, it feels like one step forward, two back to some degree. I mean, the cost of food seems to still keep rising, fuel keeps rising, and whether that's because of the conflicts and the like. Yeah, I mean, where are we at with inflation?
inflation's uncomfortable at the moment, and like probably more uncomfortable than we would have first been expecting. Some people are now forecasting that headline inflation might go through 3% towards the second half of this year. Now that of course would be the first time that it had breached that 3% high point, the sort of the highest that the Reserve Bank generally wants it to go. Now yes, there's an expectation at short term, but there does just seem to be enough sort of remaining inflationary pressure to make us a little bit worried. And some people often ask, how do you have this when you've got the economy that's in such a tough zone? It's not really a conducive environment, right, to raise prices, but you're still seeing them. And I do wonder if we're starting to see almost a 2020s version of stagflation. Now, that's a big word to use. I'm not saying we're going back to the 1970s. It's a very different environment, but you do just get the feeling that there's a little bit more of that inflationary undercurrent sitting around. Food price inflation's now re-accelerated to 4.4%. What's interesting is that last time it got sort of to this high level, and I think, we're now at the highest food price inflation since the end of 2023. The difference is at that point, it was very, very broad-based. Lots of stuff increasing in price all the time. Whereas now it's a bit more concentrated to a more limited set of items, but they're big increases. Look at the likes of butter up sort of 50-60% the last year. Mince and beef prices higher, again, because those international prices. You look at the likes of coffee, chocolate, olive oil, all of those increasing. All the good, but it's not everything, but it's the stuff that you notice so much more. And I think that's probably the difference. You've also got the likes of oil prices, yes, fluctuating quite a lot this year, but the real one, I think, and the kicker for households at the minute is energy prices. You look at electricity and gas now rising at the fastest they've been going in over 10 years. And again, it's just that uncomfortable piece where from a household perspective, you've got food prices going up, you've got energy costs going up. And the worry now a little bit more is that households, businesses and professional forecasters are all now thinking that there is a bit more inflation to come. Inflation expectations have increased. Not massively, again, not to red alert danger zones, but just to enough of a position where, again, the worry starts to creep in, sort of a bit of a pit in the bottom of your stomach around inflation sitting by. And I think that's why the Reserve Bank's in this really challenging position where they're going, the economy doesn't look great. And I worry, again, you look back to where we've been a couple of years back, the likes of inflation, when it started to get bad, it was at a time when we thought the economy wouldn't allow inflation to pass through, and we sort of almost conveniently at the time ignored actual inflation starting to creep up. Again, not fully back in the same position, but it seems a little bit too similar to completely ignore it.
That's a good segue to the Reserve Bank. By the time this episode goes to air, they will have actually, the Reserve Bank will have actually announced what the official cash rate is. Everybody's been hoping it would be another reduction, but it does feel like probably the consensus is they will hold. What was your prediction?
We were expecting a hold as well to keep the official cash rate where it is at 3.25%, but also expecting that there could be a further cut at some point later in the year. And I guess that's where, again, that nervousness creeps in, that it's a little bit hard to justify moving right this moment. There's still the clarification of what happens with the tariffs around the world, still a bit more data to come through when it comes to inflation and similar. And so I think, again, that sort of question of where does the Reserve Bank go next is probably the bigger one, and they'll have a better opportunity in August to be able to explain not only the most recent decision, but also what that future pathway looks like, because that's what everyone's concentrated on. Is there a lot left to go? Are we close to the end? Have we already seen the end? Quite a lot of options going forward.
Yeah, I suppose they're sending out letters at the moment, according to Trump's officials, and to, lots of countries that actually probably have quite high tariffs unless they do something quite quickly. So you're right, we probably might have to wait until that happens.
And I mean, you look at the market reaction as well. I mean, when the tariffs originally came through at the start of April, like that was a bit of a meltdown on the markets. What's I think interesting is that even in recent times, you've seen this sort of the markets actually continue to push higher on some economic news, but almost conveniently forgetting that it's only a temporary pause that we're seeing with these tariffs, and that some of the results could still be pretty damaging. I mean, recently we've seen an agreement with between the US and Vietnam. Mm-hmm. They came out and said, look, 20% tariff. Now that's lower than the 46%, I think, they started with. 20% tariff on everything coming out of Vietnam is still quite a lot, though. And into the US market becomes quite important because that's where a lot more manufacturing is based. Anything that transits through Vietnam sitting at 40% tariffs. And the US gets completely, free access into the market, like that's still pretty bad for economic expectations going forward. So I'm a little bit worried again that people are sort of quite happily blasé because it's been such a tough ride knowing what's coming next. But if that's any indication, again, economic growth globally will slow if you're seeing those level of tariffs. They might be better than what was announced in April, but they're not good for global economic growth.
And that's even with China and I think the UK sort of negotiating, and we'll obviously see other negotiations in the next month or so. But yeah, it feels still somewhat bleak, doesn't it? Yeah.
Very challenging. And I mean, it's one of those things for New Zealand, of course, we rely on the global economic environment to trade. At the moment, I think we're actually probably not too badly placed. People are still buying our foodstuffs. We're selling to consumers a lot more. If we were selling sort of semi-manufactured goods or sort of intermediate goods that went into the production process, if we were selling cars, you'd be in a very, very tough spot. And having been in Korea earlier this year, when again, they are a lot more wedded to not only the US economy, but to some of that more manufactured stuff, they were definitely sort of feeling the pinch a whole lot quicker than we were.
Now, interest rates also always have a bearing on house prices. So the rate cuts that we've had several, I think it's 225 basis points over the last few months. However, it doesn't appear that the heat has come back into that housing market.
No, not at all. And despite the fact that, you've got some fairly attractive interest rates on offer, you just haven't seen that same level of buyer demand spark up to the same degree. At the same time, you've got a huge number of houses that are still on the market. I think there's a few elements to that. One is the fact that there is literally half a year's worth of normal sales sitting available on the market. It takes a while to clear that backlog. You've also got a lot of new builds that have only sort of recently been finished up. A lot of selling activity potential in the market. Not as many buyers coming through. You've seen the likes of net migration pull back, so your population growth has slowed.
Yep.
But I think particularly, again, it's interesting sort of when you look at some of the indicators, after that tariff announcement in April, there did seem to be a real feeling amongst potential buyers that they actually weren't quite as keen to clamber in. Worries around the likes of the interest rate they might be paying and what it might be in the future. The risk of, do I have a job or not? Will this completely upset the apple cart? Probably more importantly, for some people that probably had their potential deposit in their investments, all of a sudden they didn't have as much of a deposit as before. That means that there's still no real reason that prices are going to be bid up. And I think for a while then you'll start to or continue to see yes, probably some price rises, but very, very muted as you go through the next couple of years. And that's probably not a bad place for New Zealand. What's interesting is it does now mean that people are increasingly going, well, okay, housing market doesn't have a lot of immediate growth in it. Where am I making money now? And that seems to be the piece where people are casting around a lot more for not only money-making options, but a wider variety of those options.
That's a nice segue into the Sharesies quarterly index, which we have released this week. And definitely there is a correlation we've seen between interest rates and investor sentiment. We've got data for the last 5 years, which is, it's a good metric. And it would appear that when rates have come down, there is more immediacy in terms of investing. What would you say?
I think there's a few elements to it. One is that generally as your interest rates come lower, some of your sort of less risky options, putting money into term deposits or similar, just isn't nearly as attractive anymore. When it becomes a little bit harder to make those returns, you're having to sort of, change around or think about adjusting your risk profile. I think it's also, though, that as those interest rates come down, they do normally stimulate a bit more economic activity on the whole, both here and around the world. And that generally means more economic activity, more selling for the businesses that you might be investing in, better returns and similar over time. So it's sort of reassuring to see that. I think also, though, the big challenge in recent times has been that greater level of volatility that you've seen coming forward. There's been a lot of rebalancing, both from retail investors, but also the big institutional guys. Like everyone's trying to figure out what the sweet spot is and sort of how to balance what is a lot of uncertainty. And the best way for that seems to be less picking one deliberate strategy and going all in, and more having that quite a bit more diversified option, which is reassuring to see because that seems to be the best method. But people are very much trying to sort of seek out those different opportunities.
We're also seeing a subset of investors, which is growing, actually looking to other emerging sectors. Like we're talking AI, we're talking crypto, we're talking defence tech, we're talking autonomous vehicles, which is it's quite exciting in some respects. Obviously, commercialisation with these sort of new tech aspects are coming to the fore.
I think also, though, the availability of some of these options to investors is new, right? Like, there are some exciting opportunities there, but some of these, again, are a little bit more unproven. And look, if you want to take that big risk, you might get that big return, sure. But equally, it might not come off to the same degree. I remember even a couple of years ago, you started to see a few more businesses that had basically sold nothing at that point, and their valuations continue to skyrocket higher and higher on this expectation of better things to come, coupled with the fact that people are seeking those sort of higher returns because inflation's been high, economic pressures have come on. They are a few people, like say not all of them, but that growing subset, keen to find a different opportunity, and I guess hoping to be not necessarily the first, but in that sort of early wave of adopters and investors, because that's where you start to make some of those longer gains over time. You get in early, you sort of ride that wave through. What'll be interesting, I think, is that at some point you will have some of these options that don't perform as well. That's just how the market works. It'll be interesting to see how people respond to that in terms of, do they get a little bit burnt and then immediately withdraw, or do they go, look, actually, this is how the markets work. I'm going to be sort of happy to keep in it for that longer period of time. I think that people generally will stick around. They're often going to be younger investors who have a bit more risk tolerance, willing to ride the wave for longer. I mean, it's something that also comes up a lot more in conversation. You know, people have been asking recently about the likes of AI, about gold, about carbon credits, about crypto and similar. But also what's interesting, I think, is even some of the subsets of certain industries. Defence is often a lot hotter and of greater interest these days. Questions around, well, actually, what are you looking for when it comes to defence assets? It's not necessarily the usual, well, if consumers get to spend more, then things will be better. For defence, it's, well, I think that the geopolitics is going to be a whole lot more challenging. So different drivers, I think, means that people are also seeking out a different sort of information than what they've had before.
And I do see, like, even in the US, they're thinking about being able to use your crypto assets as part of your deposit for a house. Even in Germany, they're looking at, banks are looking at being able to transact in crypto. I mean, we're not there yet, but it does seem to be continuing to increase in demand.
Absolutely. Not only increase in demand, but becoming more mainstream. Again, you go back sort of 5, certainly 10 years ago, and let's be quite honest, crypto was not mainstream. It was very much fringe. It was seen to be, different, odd at some points. I still think, for a lot of people that you've got to keep your wits about you in some of those areas, because for sort of every sensible approach that's being taken in some areas to crypto, there's another fart coin that comes out every second day as well. Like, the variety there makes it hard sometimes to sort of say crypto is this and it be an all-encompassing statement. There's a bit of variety in there, but it is becoming more mainstream. There's certainly more opportunity that starts to come through. And I guess also, slightly challenging to say this, but I think it's real that you look around the world, less trust in governments and similar means that people are, again, just wanting to hedge their bets a little bit more in terms of where they sort of park their money and their assets. And I think, again, for a lot of people, it's not necessarily saying, look, I'm going all in on any one sector, whatever it happens to be, but I'm quite keen as an investor these days, it seems on average to be a bit more exposed to a lot of things. And that sort of broad, diverse exposure does mean that you can pick up some of those gains when some of those newer asset classes start to emerge and provide you more potential. And I think this is where it's been interesting seeing people develop the last couple of years, when there has been this sort of implicit conversation amongst New Zealanders around their risk tolerance, because it has been for, when term deposits were high, well, you didn't have to think about risk tolerance. You parked your money in something that just gave you, it just continued to provide at a high and high level. Now that you've got to be a bit more discerning, I think that's where the level of interest is coming back. I mean, same in terms of the number or proportion of people on shares, as I expect, who are buying companies specifically. Again, a little bit more nuance there, where people are going, look, I've done a bit of research. I want to make sure that I understand my exposure a bit more. These are the areas I'm starting to push into. So again, I think we've got a more discerning, a sort of more direct investor starting to come through.
Brad, just thinking about the US economy, there were lots of predictions that with the tariff uncertainty and the like, that economy would start to slow. We actually aren't seeing that, maybe because the tariff situation is on again, off again, but really it does seem that it's still a powerhouse.
Yeah, the US economy seems a little bit unkillable on that front. I mean, but seriously, I mean, you're right. People were expecting economic activity to pull back, for inflation to spike a whole lot higher, for unemployment to start to increase. You just really haven't seen too many of those signs. I think underneath the surface there's a little bit in the data that does suggest, again, more challenges. You look at the likes of some of the revisions that keep coming through to employment numbers in the US. They do generally continue to be revised lower on this sort of second and third publish. But again, there's still enough in there. There's still enough jobs growth that's keeping the economic motor humming. I do wonder if part of it is a timing thing. You have had in recent times a whole lot of uncertainty. People have generally probably just tried to keep on moving forward, haven't known what way to sort of move in terms of investment or otherwise. So I do wonder if it might be sort of, again, you start to see those impacts a little bit later on. But again, even then, the economic motor in the US still seems solid enough for the moment. With the Fed is still talking about sort of 1 to 2 rates cuts this year still as well, which is sort of the weird thing, is that the economy looks robust enough, underlying conditions look a little bit weaker, which might allow you to cut interest rates a bit more, but you're certainly not going to get some of the larger cuts that some people, I think, hope for to try and stimulate even more activity. And that's probably the right spot for the US in general. But it also means that increasingly, earlier this year when the tariffs were announced, people were saying, well, I'm going to completely move away from the US, I'm just not going to park any money there. I mean, people have come flocking back pretty quickly because there's still good returns. They're still looking at other opportunities too. Europe still seems to be a bit more in interest than before, but certainly those US numbers look a little bit more solid. I guess the question will be, as we continue through the year, do you see a bit more of a trend start to emerge on either direction? Because I think that's almost part of the problem, is that the US economy is a little bit directionless at the moment. You're not sure if it's about to trend down or trend up. It's just moving forward at a solid pace without sort of any movement up or down.
Yes, and markets are definitely hitting record highs, the Nasdaq and the S&P 500. So it's I can see why investors, particularly on Sharesies, we have about 80% of our trading is in US. That said, 41% is held here in New Zealand. So there's a bit of a difference there. But in terms of trading, that's definitely where people are still gravitating. Yeah.
It's interesting as well, right, with the volatility that's come through, because I mean, you look at some of the days we've had this year, like wild times, and watching what would, previously have been a couple of weeks or months of movement happen, within seconds or minutes has been quite hard to stomach sometimes. And even amongst that, actually, it looks like people have been buying in a bit more. I'm not going to say everyone buying the dip, but I think there's been this sort of recognition from a lot of people that, hey, sometimes the markets have been, I think, maybe overcorrecting or a bit overly worried about things and then seem to come back the other way. Now, let's be real, I also worry a little bit that the markets sometimes undercook or don't forwardcast as much of the challenging conditions and sort of take good expected economic news and sort of just run with it. But what was fascinating, I think, is also in recent times when you had conflict in the Middle East, we'd been expecting the likes of oil prices, some of those other commodities to spike up sharply. There wasn't anything. In fact, in terms of actual market action, I think most of the US market numbers actually went higher despite some of those commodities starting to show pressure. And I do wonder if everyone's become a little bit numb, in a sense, to just how many of these big geopolitical things come through. And people are now starting to look a little bit more at the numbers and going, okay, yep, some people are expecting certain things, but until I actually start to see them, that expectation move to reality, I'm going to look at what's actually right in front of me, what's actually being reported here and now, and move with that. And I think that's quite a different market than what we've seen previously when you jumped at shadows. You jumped at any sort of little tidbit of information. Now people seem to be not only holding back, but going, look, when there is actual real information, I'm going to work on that. I'm going to pile in a bit more, and I'm not going to react nearly as much to sort of just some of that broader stuff in the expectation piece. That's a shift.
Let's jump back to New Zealand and how businesses here are feeling. There's been a number of surveys out in recent weeks. They were looking at a recovery, but what would you say, where's sentiment now?
Sentiment's okay. And I guess I say okay because depending on how you look at it, in some areas the economy still looks weak, forward expectations still don't look great, but confidence about what's sort of coming up next is still improving, if you will. And I think that's, again, probably indicative of where the economy is moving. It's improving slowly but surely, but it's sort of a sluggish one. People are still worried in different sectors about how they'll go. You look at the likes of the construction sector, again, pretty tough in many respects. Retail, a whole lot more mixed. manufacturing a whole lot more mixed, agricultural, primary sector in a good spot. But I do think as well, second half of this year, you do have people that are refixing onto those lower mortgage rates. Everyone's trying to act a little bit more limited in terms of their investment intentions and similar. There seems to be this view of, look, yes, there might well be better things to come, but I'm going to be very careful with my money as a business. I'm going to be careful with my hiring, and from a household perspective, everyone seems to be more careful with their cash too.
Yeah, jobs. I would have thought they would be coming back a little bit by now, but the figures aren't really telling us that.
Every time we get monthly job numbers, they seem to show a little bit of a slight tick up, but then that almost always gets revised again within the next couple of months. And the more interesting indicator in recent times has been the number of job ads that are out there, the number of job opportunities that you can apply for. And in seasonally adjusted terms, they've basically been flat now for just about a year. Now, that's flat at sort of levels that we haven't seen since about 2013 or so. So it's been a long time. The fact that they're flat is good relative to the idea that they could still be falling, but it also says that if they've been flat for nearly a year now, there's not really any real trend of them starting to pick up any sort of momentum. And you do just get this feeling again from businesses that they are in this sort of holding pattern where they would love to employ more people. They just can't see the sort of expectations for really strong things ahead enough for you to start to hire a whole bunch more. You're seeing that as well, a lot more young people that are becoming unemployed. That's the group who are often losing their jobs, some of them heading for Australia and similar. So some of those trends, I think, are fairly well established at this point. We also haven't seen any real trend that they're starting to improve any quicker than we might have expected. In fact, in most cases, they're taking a whole lot longer.
Now, Brad, is there anything positive that investors can look to? Where is there any silver linings?
In some areas, there seem to be some decent enough deals on in terms of the prices that you can get various stocks and options and similar for. And again, where there's you've done a bit of homework. Other options seem to be far overvalued considering what they're delivering. But again, that's very case by case. I guess what's interesting is that normally when we look at different sectors, there's quite a general environment, right? You look at retail and you go, oh, well, all of retail's not doing that well. It's been interesting in the New Zealand case that you see a few places where they put out an announcement like, look, trading conditions have been worse than we thought. We've seen, poorer results than we've been expecting. But other areas sort of a little bit quietly, but pretty confidently going like, hey, numbers are not bad at the moment. We're going all right. Even within sometimes the same segment, which really does go to show that there's a very discerning environment again, where it's not sort of just everything moving in one broad thrust. I do wonder as well if that means that people are taking more notice of businesses' strategies, who's on the board, what sort of movements they're making and how quick, because this does seem to be quite a dynamic environment. Now, by that I mean it's shifting so quickly that I do wonder, people seem to be a lot more interested in executives. What are they doing? What's the board doing? Have they made changes quickly enough, or have they sort of allowed things to just sort of languish and then all of a sudden, some big changes come through. They haven't reacted to, be it, government cutbacks. They haven't reacted to how the market's been shifting. So I do think that there's been an interesting variation in the reports. Like I say, genuinely some going, look, it's pretty tough out there. And sometimes operators that you thought would have been a lot more solid or stable through a downturn. But equally, some areas of the market where you go, geez, that's pretty impressive that you're still able to make some pretty good numbers happen. It's a bit more, what has this company got going on below the surface? How are the board performing? How long have they been there? What are they up to? Are they agitating for change? What's the executive team doing? What's the strategy in that? I do wonder as well, I don't think there's a good indicator here in New Zealand, but like how many people are showing up to the likes of AGMs and similar to try and make sure they either get their point across to management and the board, but also trying to gain a little bit more information of what are you taking us forward into, because it is uncertain. You've got to be nimble, and I think people are sort of casing out boards and management a lot more than they did before.
Is there anything investors should ignore if we end on that?
Sometimes it's very easy to doom scroll, right, in this environment, like be it, US sort of market changes and similar. I guess probably a need to keep your wits about you in terms of how current your information is. I remember when the likes of, you saw conflict in the Middle East recently, I was sometimes reading analysis that had come out that basically had missed the mark because it had come out too late. By the time someone had published and been like, look, there's a risk that oil goes to $110 a barrel. Oil had crashed back below 70 all of a sudden. And it was just, so there is a real need to be very, very current, or to at least be sort of aware of when stuff has been coming out so that you make sure you've got the latest stuff. But also, like I say, not doom scrolling too much, because there's a lot out there that as an investor, as a person, you just can't control. And so it's, I think, more trying to put some of that aside, looking for where there is actionable intelligence that you can actually base a bit more of a decision off, that you might be able to do something with yourself. Having a bit of a clear-headed strategy, working the information in, and then making a decision, that'll probably put you a lot better than sort of just blind reacting to every sort of market movement. Because certainly the thing that I've experienced the last couple of months, people are coming forward with a lot more questions about that volatility. They're going, hey, this has moved massively, should I be concerned? And normally the answer to that question is, if you were concerned, you should have been concerned before the big change came through. So if you've got a good strategy, if you know where you're going, I think that gives you a lot more confidence as an investor as to what you're thinking about for the future.
Yeah, sometimes it pays to hold, doesn't it? But you don't want to put your head in the sand at the same time.
That's the balance, right? You've got to have enough recent information to be able to make good judgment calls, not so much that you get bogged down, put your head in the sand, not so much either that you jump at every moving shadow. It's a very delicate balance.
Well, Brad, we could talk forever as usual, but it's time to go. Thanks so much for coming into the studio.
Thanks for having me. These are always great fun.
And thanks to everyone for tuning in. You can watch Shared Lunch on YouTube or find us on your favourite podcast app. Leave us a rating and tell us what you'd like to hear next. Mā te wā.